Surged 80% in 6 days to $120 a barrel, then it crashed back to $76. Insane volatility. And for any traders or investors who got baptized in the meme stock craze of 2021, this might seem a little bit familiar. But oil is a very different beast than meme stocks, and in today's Stocks in Translation, we're going to tell you what you need to know before taking the plunge into oil trading. First, oil is a cyclical market, not a stock that trades on vibes. Though it can be speculative, oil is about barrels more than buzz. It trades on real things like supply, demand, inventory, shipping, geopolitics, even refining. And most importantly, oil supply can adjust. Higher prices can bring out more production. Demand can then cool, inventories can build. That is a very different formula from a meme stock, where hype, it can snowball and flows they can feed on themselves. Price can detach from fundamentals for very long stretches. But in oil, big spikes, they often fade. Sometimes that happens in meme stocks too, but other times big spikes attract even more chasers. Now let's take a look at this long-term crude chart going all the way back to the start of the century. You're going to notice some big spikes, two in particular, but the bigger picture is that over long stretches, this market, it tends to go sideways and cycle. So oil really isn't a buy and hold investment. So back to those spikes, they are very dramatic, and you can see those huge two surges that really stand out. First, in the run-up to 2008, that big spike to the left, when oil went parabolic, and it collapsed spectacularly. Then the 2022 shock right over here. That was happening right after Russia's invasion of the Ukraine. That capped a multi-year move off of the pandemic lows. And at the very far right edge right here, hard to see, you had the latest war-driven surge, which has been fast and violent, but the spike is still much smaller than the other two big ones. And there's really no way to tell if it's going to turn back up again. And that is the second big lesson here. Geopolitical oil spikes often fade faster than people expect. Why? Because the market shoots first and asks questions later. Traders see the risk of a supply hit and they buy first. And then over time, the market starts figuring out all the actual damage. And well, it goes from there. But if you time the bottom and the tops of these moves perfectly, sure, you could have made some money, but investing long-term in a sideways market usually isn't the best proposition. And then chasing headlines tends to end in tears. Now here's the part longer-term investors really need to understand. If you buy USO, you are not buying barrels of oil in a tank, you're buying an ETF that owns oil futures. And a futures contract is just an oil bet for a specific future month. Those contracts expire, so the fund has to keep selling old ones and buying new ones. That process is called the roll, and the roll can help or hurt your returns. And that's why over time, USO and the underlying crude oil futures contract do not usually track each other, as you can see here in this chart of both of them.